In today's investment world, China remains one of the world's largest and fastest evolving economies. However, for many retail investors, investing directly in Chinese companies can feel complicated, especially if you're new to investing or not familiar with the markets. This can range from navigating different share classes to dealing with market restrictions as a foreign investor. And that's where ETFs comes in. They offer a simple and cost-efficient way to participate in China's growth story all through a single investment product. And for today's discussion, we'll be talking about how you can start investing in China through ETFs. And I have with me today a young and curious investor, Feng Yi. Feng Yi is starting her investment journey and like many of you, is also wondering how she can invest in China. Feng Yi, welcome to the show.
Thank you so much for having me. I'm very excited to be on the show, and I think I'm very lucky today to speak with two experts who are also in the investment space. So first, we have Emerald Yau, who is the head of Equity Index Product Management, APAC at FTSE Russell. Nice to meet you, Emerald, and thank you for joining us at our podcast.
Nice to meet you as well.
Next, we also have Roger Leng, who is the Director of Intermediary Sales at UOB Asset Management. So Roger, thank you for joining us too.
Hi, everyone.
All right, so let's start with the big picture. So when investors talk about gaining exposure to China, what does it actually mean? And are we referring to companies that are founded and listed on Chinese stock exchanges?
Yeah, I think that's a default, right? When you think of China equity listed on, China Stock Exchange is kind of a default. Shanghai Stock Exchange, Shenzhen Stock Exchange, these are called A shares. But Chinese equities is way broader than that. There are Chinese stocks listed in Hong Kong, in Singapore even, as well as in the States. But by far, the A shares market, the ones that's listed in China, that's the largest market. It's in fact the second largest equity markets globally.
I see. Just now you briefly mentioned it. So I wanted to ask, when it comes to investing in China, we often hear about what you mentioned earlier, the different type of share classes like A share, H shares, right?
Yep.
Could you share a little bit more about what these are and how are they different?
I think the key differences are, one is the incorporation, where are they incorporated? Two is where they're listed. And three is, what the trading currency. So for A shares, these are listed and incorporated in China, traded in renminbi. And for B shares, these are also listed in China, incorporated in China, but these are more for foreign investors earlier in the days. X shares listed in Hong Kong, also incorporated in China, but these are, in Hong Kong dollar trading currency. Now, there are a bunch of that is not incorporated in China. That included the red chip listed in Hong Kong. These are typically the state-owned enterprises. P chip also listed in Hong Kong, and these are the private company. S chips listed in Singapore, and the N shares listed in the US. These are also typically private companies.
So I'm just curious, right? So with the FTSE Russell China A50 Index is a free float market capitalization weighted index made up of the 50 largest A-share companies listed on the Shanghai and Shenzhen stock exchanges. So this includes major names across sectors like finance, consumer goods, industrial and technology. Is it possible that this index is serving as a reliable proxy for the broader China's equity market?
A-shares market is second largest in the world in terms of, the equity size. But, 50 stocks really is less than 1% in terms of the number of stock count versus the entire A-shares market. However, because these are the largest companies, this actually reflect from a market capitalization standpoint, more than 1/3 of the entire A-shares market. And if you're looking at just the large cap piece of the A-shares market, this 50 stocks represent about half of the market cap.
Wow. Okay.
Yeah. So you can, think of that as like, wow, that is still quite relevant. And in fact, out of the 11 industries that we classified, the China A50 Index incorporated, contains 10 out of 11 industries. The only one that's not in there, real estate.
Roger, I just want to ask you a question, right? So if let's say I'm an investor and I want to invest in China and I see about the A50 index and it kind of makes sense to, get a very good proxy to the Chinese market because, about 33% of it being represented in terms of market weightage. But, it's quite difficult for an individual investors to invest in all 50 companies. That's unrealistic. It's probably impossible to also invest it in terms of the market cap weightage because, you got to buy in the correct proportion in terms of the portfolio. So that's why on the Singapore Exchange, you have the UOBAM FTSE China A50 Index ETF. And the objective of this ETF is to replicate the performance of the FTSE China A50 Index. In other words, the ETF manager invests on behalf of the investors in these same companies, make up the A50 Index, right? As an asset management firm, what is it about the China A50 Index that makes it an attractive benchmark for investors who want exposure to Chinese company? And also, I just want to ask, is it a truly diversified portfolio, or does it also have its fair share of biasness to certain industry? For example, I think real estate is currently not as well as represented.
So for the product itself, the UOBAM FTSE China A50 Index itself, right, the ETF itself, from an investor standpoint, I think it does help to give you that exposure to the largest 50 companies that's listed on both Shanghai and Shenzhen Stock Exchange, like what Emerald have shared. I think from a Singapore investor standpoint, I think that is a great way to get yourself exposed to the 50 companies. And what you want is the largest 50 companies. So instead of going individual stock itself and trying to make up sense of how much should I allocate into specific companies and so on and so forth, that ETF already gives you that kind of exposure to the largest 50 companies. And in fact, investing in China itself, the key is more about getting exposure to the 50 largest, because there are so many companies in China itself, you do not know the risks. And we here in Singapore is also facing the difficulty of trying to understand each and every company. I mean, the Singapore Stock Index itself, right, the STI Index, is already quite complicated to a certain extent. Then why do you want to get yourself exposed to another index which is a lot more complicated, which have so many companies? So if you want to go and get yourself exposed to the China growth, in a sense, I would say that's actually a fair representation. You just want to go for the biggest 50 and you have the biggest market cap as well. So on the second question itself, is it biased and all that? I guess it goes back to the market cap, because it's a market cap index itself. So right now, I think the largest index, or rather the largest sector itself is financials. So it makes sense as well, because there's a lot more growth opportunities within China itself. And I think we have seen that as well. So, and I think the second largest on UOBAM, the ETF faction itself, we listed IT as actually the second largest. And that's also because there's a combination of other different sectors that probably, classification of that company as IT instead of another sector, let's say for example, industrials. So from the IT sector, and we know that there's a bit of a boom market right now in China, so that also gives you that kind of representation and the replication as well.
I guess the ETF is always dynamic, so it reflects the market condition. So technology companies are doing well, consumer goods are doing well. That's will likely form the biggest weightage of the ETF. As opposed to, it being just a static ETF that doesn't evolve when technology or when trends do change, right?
I think that is also quite true as well, because I think over the last 20 years, I think the index have evolved from different sectors and how it has evolved to what it is right now. I mean, real estate is not in.
For now.
So there's a lot of changes. And I think the key point, like you mentioned, is the dynamism of it. Because I think the index itself rebalances on a quarterly basis. So as an investor, again, you'll be thinking, I'm in financials right now. Next sector or next quarter, right? Would I be out of it? Will I be misrepresented? Am I having less representation in financials because it's supposed to be doing well? Or I want to go into tech, but it seems like it's not being represented. So leave that to us, leave that to the experts. We are the ones that are doing the rebalancing. FTSE is the one doing the rebalancing on a quarterly basis. You as investor, you get the best of both worlds.
I get where you're coming from, because I think ETF is like a practical way for investors to actually gain exposure to an index. So personally, as a beginner, I also invest in ETFs. I think it's quite a fast, free way for us to actually get exposure to a broader set of companies, so you don't have to stock pick, you don't have to fuss over that. That's also based on my own experience, and I wanted to ask, beyond just replicating the index, what other advantages do investors, especially those based in Singapore, enjoy when they invest in this particular index ETF?
I think the biggest advantage is actually the Sing dollar currency itself, because it's listed on the SGX itself. So like what Emerald shared, your A shares and your B shares are all denominated in renminbi. And the H shares are denominated in Hong Kong dollars. So from a Singaporean standpoint itself, I mean, right now in this internet era, I think there are a lot of platforms out there. There's a lot of brokers out there. You do get that chance to get yourself doing the FX, changing your currency from Sing dollar to whichever currency that's available. But end of the day, it's also ability for the Singaporean investors to buy into an ETF listed on the SGX in Sing dollar terms. I think that's the most fast, free way. And of course, the second point is also about the product is considered as an EIP. So it's considered as an excluded investment product, EIP in short. So you do not need to go through excessive assessment, which is your currently I think is your CAR and CKA assessment, and that also helps. And then lastly is EIP, so it's very easy. And the ETF itself is also SRS registered as well, SRS approved. So you can actually use your SRS monies to invest into the ETF as well.
And just now we touched a little bit on currency risk. I wanted to expand this a little bit and ask, right, for retail investors who are actually considering this index ETF, what should they consider or be aware of before investing?
Investing in China is supposed to be a long-term kind of a growth story. And that's why we also encourage SRS investment as well. But why we say long-term is because we have seen how China has evolved over the last 20, 30 years. The last couple of years has been a lot more jittery. There's a lot more ups and downs. The swings are there. We've seen the crackdown. We have seen the symbolic handshake and so on and so forth. So you have to be able to withstand that volatility, and you have to understand and be patient. That is not fly-by-night kind of a thing, whereby, am I seeing 20% gains overnight and all that thing? I mean, it may happen, but you shouldn't be expecting that.
And the volatility will also naturally comes in cycles as well. So even if you get a 20% up in a year, you could lose 10, 15% the next year, right? I think I got one question which in my conversation with a lot of retail investors in Singapore, when we talk about overseas markets, especially China, some people have this point of view that you can't be a passive investor because they feel like, you want to be able to seize the opportunity of knowing which are the companies that you want to invest in. And sometimes these companies are still quite small. They may not be in the index right now. So they feel like, hey, if you are only investing through an index-based ETF, you're going to get the biggest 50 companies that are already represented and probably already doing well right now, but you're going to miss out on some of the smaller companies that could potentially capture good growth in the next few years. Is that a view that makes sense? Because sometimes when they explain to me, it kind of makes sense.
Look, I mean, if I can go back to, these are the 50 stocks, and these stocks are the largest companies, right? These measures, this index actually transforms alongside with China's transformation.
That's true.
Right? So even like, in the 2010s, in the mid 2010s, the financials plus real estate is like about 70%.
70%? Oh, wow.
Yes.
What is it today?
It's about 30.
Right. So it does adjust.
It evolves, it adjusts. And, Roger mentioned that, our index is rebalancing every quarter. So, if the stocks get larger, it will get into the index. And I can see that very clearly on, how this index has transformed. This from very financial heavy to, when the government is moving from investment-led to a consumption-led model, growth model, that consumption has gone up. And recently, just this year alone, at the end of last year, so our technology plus telecom equipment type of stocks together is only 3 stocks. Less than 10%.
Right.
Today is 6 stocks.
Okay.
And over 15%.
Because those industries have performed well over the past 12 months.
So what I want to say is investors don't need to be, very close looking at daily on what am I going to invest in. This is a tasting menu for you. It has, everything that is, capturing the China essence.
Right.
I'm not saying you can't order, a Peking duck on the side, right?
If I want to try that.
But, it's a great tasting menu that, has a lot of different growth opportunities and investment opportunities already baked into it.
So would you say that that's kind of like the ETF, in the index ETF kind of track is like the core of your portfolio in China? And then maybe if you have a tactical view on certain individual stocks that you can, order a side dish but maybe not put all your money into just that 1 or 2 companies.
Exactly. So, I mean, if you have to do your homework, right, for investors, or if you have done your homework, you're extremely bullish on a particular company, there's nothing restricting you other than, you have to find a broker that can access the Stock Connect program for you to buy that stock.
Right.
Otherwise, it is, just go with the ETF as a core, as you say, having that tactical view on the side.
What type of investors do you think like this index would suit? And also, how it might fit into a regular, typical Singapore like retail investor's portfolio?
I think this ETF itself, right, I think it suits somebody that is really keen and very positive in terms of China's growth story. Of course, for this 1 year itself, I think we have seen how the markets have moved, and I think that there's a lot of stories coming out. Everybody wants to be a stock picker in Singapore. Okay, I think I've seen enough. I've spoken enough to a lot of clients and at events and so on. So I think everybody wants to do that. Nothing wrong, but like what Emerald has said, you need to do a whole homework very well. You need to believe, firstly, again, going back to the China's growth story, that's one. You are positive on it. You understand what kind of risk you are being exposed to. I think that's important. So that's where you create like a China sleeve in your portfolio itself. Most of us, we probably have all your US stocks inside. Right. Most of us probably will have Singapore inside as well because it's gaining a lot of traction as well. But within Asia itself, I think that is a little bit lacking. You may not have that direct Asia exposure. And that's where within Asia itself, Singapore is moving fast, so much traction, so much all this news coming in and all that. Maybe besides Singapore, where else can I look for opportunity? And that's where China comes in on a longer term basis. Because end of the day, China and Singapore, I think we are great partners as well. So if Singapore is growing, I'm quite sure China is growing. Vice versa, if China is growing, I'm quite sure Singapore is growing as well. So I think that's from a allocation standpoint.
I think also when you think about even using the food analogy, right? If you were to just be investing in Singapore companies, let's say the STI, chances are you're getting a lot of banks as well as real estate companies, you know, that is part of your menu because the Singapore market is a bit biased towards this industry. Whereas I think when you look at the China A50, you're looking at companies that maybe are not, so prominent in Singapore. So you got your semiconductor, healthcare, telcos, data centers. I think that's a bit of a different menu, so as to speak. Collectively, I think the industries complement each other really well.
I think briefly you mentioned about like believing the China's growth story, right? I think we have also seen that the China's market has experienced like periods of volatility. So I was wondering, like, especially in the recent years, so how should investors actually approach these, be it in the ETF or, if like you mentioned, they like to stock pick on their own, is this opportunity of investing worth the risk?
Basically the risk, because a lot of people are like, sometimes, they lose money and they're afraid.
Well, I mean, China is still a EM market, emerging markets, right? So ups and downs are expected. I'm not going to say, China is going to only go up and never go down, right? So realistic is there's going to be volatility. This is a part of your investment journey. But these are the 50 largest companies. Typically, these companies are more stable, are less volatile than the smaller cap. So if you're looking at Asia's market as a whole, this is the parts of the more stable parts.
I think one of the names within the index itself is BYD. So we all know BYD very well in Singapore. I think it's the top car seller.
I think the top EV seller.
Besides the EV, I think it's the top car seller as well.
And restaurants also do quite well in Singapore.
And they have ads all around. They are saying that I have 10,000 BYDs on the roads and whatnot. But the caveat is, yes, I don't own a BYD. But just saying out there that, so again, you will see the growth of the BYD, for example, in Asia and in ASEAN itself. So being in one of the constituent of the index itself, that also gives you that opportunity to buy into the success of the story. So besides BYD, we have other brands. So one of the other one is actually Maotai. So we know your baijiu here in Singapore, even though it's luxury kind of a consumer good in that sense, but also tells you in terms of where's the growth in terms of Chinese story as well. So if there's a lot more additional consumer spending coming in, like what Emerald has mentioned, from investment-led to consumption-led kind of a growth, then these are the names that will actually benefit from it. So I think that gives you the opportunity, and it gives you a little bit of the investors will be a little bit more familiar with the names because they know about BYD, they know about Maotai, your Baijiu, and I think some of the banks as well, your ICBC is there, and even Ping An Insurance is inside as well. So again, Ping An is also a big name. We all know how it works, and so these are not unfamiliar names. And going back to the point about like what Emerald has shared, CSI 300, I think even though it's the 300 biggest or 300 names in the index itself, in fact, the volatility is a lot higher as compared to your China A50 index itself. So even though you have 50 stocks, but your volatility is lesser as compared to a 300 stocks kind of index.
That's a very good point.
I think that speaks to me a lot. So because as a newbie, right, for example, when you hear these names and they are names that you have seen and you have heard of, then you feel like, okay, I'm a bit more comfortable.
So even though these are maybe some of the names you recognize, I think the idea here also, just for people who are watching, is that we're not exactly banking on these companies
Correct.
either, right?
Correct,
So if they do well and they continue to perform well in the index, that's
Right.
great. And if you're an investor, you generate some returns.
sure.
But if they were to not perform well, let's say one of those names that Roger
Yes.
cited don't perform well in the next decade, then they will naturally be excluded from the index after a while,
Correct.
which is why I think this index is always dynamic, it's always evolving.
China transformation
Yeah.
is captured in these 50 stocks. One of the other thing was what I mentioned before, right? It's like the technology.
Right.
This year, with all the conflicts going on between US and China, China recognized that it needs to be more self-sufficient, self-reliant on technology. So,
Right.
there's a lot of policy supports behind the scenes. So you see semiconductors companies getting into the index, the telecom equipment companies that's manufacturing optical module that are very important for data center, for the 5G and AI infrastructure. Those are also getting into.
And those are very macro trends, in terms of China always evolving. In fact, I noted that since the A50 index was incepted in 2003, that's about 22 years ago, there's actually only a handful of the original members that still in the index today, right? So it's kind of showing that, what was good 22 years ago is no longer reflective of today's economy, right? I just want to ask, how does this reflect the changing of China's broader economy over the last 2 decades, essentially from old economy sectors to now tech, finance, consumer names?
Yeah, definitely. I think we touched on some of these earlier as well. It's just, the 50 names carry through the China's transformation within from a financials heavy, just, 10 years ago to now, becoming more consumption and technology importance, right? So, this is definitely capturing that change, but also capturing in there is also the China's transformation to a more green economy. So BYD, as Roger mentioned, is the EV company that's very successful, but also battery technology companies is in there, hydropower company is in there. So you can see that it's also capturing that accents as well.
Fengi actually had a question for me before you guys come, and I don't think she wants to ask, so I'll just ask. I don't know why she asked me, but she said that is there dividends? I think she's thinking of passive income.
No, because I was thinking since they are mainly growth, right? We should be focusing on growth stocks. So I was thinking usually growth stocks don't really give dividends. So I wanted to ask them.
Are you looking to retire?
I mean, everybody got different risk profile,
That's
right?
true. Yeah,
Some
yeah,
people
yeah.
might risk appetite don't focus on growth.
Roger, how would you answer that?
I would say that for investors that are looking at this ETF itself, right, this is really predominantly a growth story kind of thing. Yes, there is that element in terms of the dividend coming in, but of course, from our standpoint, from UOBAM standpoint itself, we don't guarantee that. But I think when clients are looking into this ETF, they shouldn't be focusing on the income point of view.
Right.
There are numerous income ETFs out in the market.
In Singapore,
whether is it listed on SGX,
the STI will probably
Hong
give you a
Kong,
better
or even
return.
on the US as well. So from our standpoint, when they are looking, this ETF is really buying into the story of where China's growth is coming in. As CATL, one of the biggest, in fact, the biggest battery maker in the world, is part of it as well. So we all know BYD. We all know Tesla, but not many know about CATL. Of course, I think increasingly there's a lot more knowledge about it. So CATL is actually the battery maker for Tesla as well. So this is also, again, going back to the point about the growth story and how China has evolved from being a very investment-driven economy to a consumption-driven economy as well. So
And CATL is the second largest company in the index.
Right.
Yeah.
As an investor, when you look at the Chinese market, you're not really exactly looking for dividend or income investing. It's more like growth investing.
Yes.
That was a great discussion, and I hope today's episode has given you a clearer picture of how ETFs can provide investors with a simple and effective way to gain exposure to China growth story. And we've heard about how the FTSE China A50 Index represents some of China's largest and most established companies, and how you can use an ETF like the UOBAM FTSE China A50 Index to actually invest in the market or through a locally listed regulated product that we have here on the Singapore Exchange. Big thank you to our friends from UOB Asset Management and FTSE Russell for sharing your insights with us today.
Thank you.
Thanks for having us as well.
If you would like to learn more about the UOBAM FTSE China A50 Index ETF or explore how ETFs can fit into your investment portfolio, you can visit uobam.com.sg or FTSERussell.com for more information. If you like this episode, don't forget to follow us on YouTube or Spotify, wherever you're listening or watching to this. We'll see you again.